Welcome to our earnings conference call for the annual results. Along with me, I have Mr. Samir Hirmat, Joint MD and CEO, Mr. Kuldeep Jain, Financial Controller, and Strategic Growth Advisors, our Investor Relations Advisors. I hope you had the opportunity to take a look at our Q4 and FY18 results, which have been circulated and uploaded on our website and the respective stock exchanges. Since we are hosting the conference call for the first time, I would like to give a brief update on the business model of the company. Hikal is a leading sustainable technology-driven company manufacturing advanced intermediates, active ingredients, and active pharmaceutical ingredients. We partner with pharmaceuticals, life sciences, biotechnology, agrochemicals, and specialty chemical companies to deliver active ingredients, intermediates, and R&D services. We are one of the few companies globally with a hybrid model catering to multiple segments across the value chain. Our company has 5 manufacturing facilities and 1 research and technology center. We have 2 divisions, the pharmaceutical division and the crop protection or agrochemical division. Our pharmaceutical division contributes 60% to the revenues, with the balance 40% contributed by the crop protection division. I will now discuss both the divisions in brief. Our crop protection business. Hikal partners with crop protection companies for custom synthesis and custom manufacturing of intermediates and active ingredients. We manufacture herbicides, fungicides, and insecticides. We also have our own niche portfolio of products for the specialty chemical and biocide industries. Contract manufacturing approximately contributes 70%, with the balance contributed by our own proprietary products and specialty chemicals and biocides. In contract manufacturing, we work with global innovators. We have a proven, successful, and scalable track record of developing crop protection products from gram to kilo to ton scale at our Kilo Lab, pilot plant, and commercial plants, which meet the stringent regulatory and customer requirements. We work with several of the top crop protection companies globally. Majority of the crop protection business is export-oriented. We have 3 sites dedicated for crop protection, 1 at Mahad, the other at Taloja, and 1 at Panoli. In our crop protection division, we have around 10 to 11 products in the contract manufacturing business and about 5 to 6 of our own products. No single product in the contract manufacturing business constitutes to more than 15% of the business. Currently, we have 9 to 10 products under contract manufacturing. We are also working on a few niche patented products in this segment. In the specialty chemicals business, we offer specialty biocides and antimicrobial actives and additives. These products are used in industries like leather, paint, paper, water treatment, personal care, building materials, and textile industries. Now I'll talk a bit about our pharmaceutical business. We are a leading custom development and API manufacturing partner to global innovator companies. Our team has extensive domain expertise in developing products and an established track record of scaling up from gram to kilo to ton levels of production. We partner with global pharmaceutical companies in contract research and development, where we offer contract research services for synthesis, process development, and manufacturing, custom synthesis and contract manufacturing of intermediates as well as APIs. Approximately 50% of our business comes from contract manufacturing, and the remaining 50% of the business is generic by nature. We have about large-scale 5 to 6 products in contract manufacturing and about 8 to 9 products in the generic portfolio. Majority of our pharmaceutical business is export-oriented, with about 55% of sales coming from the US, 30% coming from Europe, and the remaining amount divided more or less equally around the rest of the world. We have 3 sites dedicated for the pharmaceutical division, 1 at Panoli in Gujarat, the other 2 at Jigni near Bangalore. A little brief about our manufacturing facilities. We have 2 units in Jigni, Bangalore, Unit 1 and Unit 2. These are pharma manufacturing sites. Unit 1 is approved by the US FDA for manufacturing intermediates, advanced intermediates, and APIs. We have another site at Panoli, Gujarat. This site received US FDA accreditation in September 2012 and EU GMP approval in 2014 of January. We manufacture intermediates and advanced intermediates at this site. We also have a chemical facility adjoining this site, but separated, which manufactures products for our crop protection division. Another site that we have is in Mahad, Maharashtra. This belongs to the crop protection division. It is the first manufacturing site of Hikal. It was established in 1991, and the site facilitates the manufacturing of specialty chemicals, fungicides, herbicides, and intermediates. The site also manufactures on-patent ingredients for innovative companies. Our other site in Taloja, Maharashtra, which also belongs to the crop protection division, was commissioned in 1997 in a technical collaboration with Merck and Company in the U.S. The site facilitates manufacturing of fungicides, insecticides, and intermediates. This site also manufactures on-patent active ingredients for innovative companies. Pune. Our research and technology center is in Pune. It provides process research and technology development services for both our divisions. All these sites are frequently audited by multinational innovator companies from US, Europe, and Japan, besides the mandatory audits by the respective global regulatory authorities. We would also like to highlight that last year we successfully completed the 5th US FDA audit for the Jigni Unit 1 Bangalore facility with 0 observations by the US FDA. Now, a few updates on our performance for the financial year ended 2018. During the year, the company's long-term credit rating got upgraded from BBB+ to A- and short-term credit rating from A2 to A2+ by ICRA. This year, we are working towards and expecting another upgrade with respect to our credit ratings. Our strategy for the company is to service our existing contracts, gain market share in our generic APIs, build and develop new relationships with innovators, whilst we develop new APIs for our generic product portfolio. We are doing this by diversifying our product and client base while expanding our capacity to meet the increased demand. Our target is to file 4 to 5 DMFs every year and continue to generate our own intellectual property through process patents and differentiated technology. As a company, going forward, we expect 15 to 20% growth over the next 2 to 3 years. We are positive on maintaining the current margin profile for both the segments. Now, as a strategy, we are progressing towards more value-added products and opening newer and emerging geographies like Russia, Latin America, and others where we are gaining traction. In case of the pharma division, 40% of our customers are repeat clients. We are strengthening our generic portfolio with new launches in the upcoming years and are working on expanding our portfolio of business with existing clients on the contract manufacturing side. Coming to our financial performance of the company, I would like to hand over the call to our financial controller, Mr. Kuldeep Jain, to highlight the same.
Thank you very much, Anish. Good evening, everybody. My name is Kuldeep Jain, and I'm a financial controller for the organization. Anish has already taken you through with the businesses. I'll take you through the financial for the March 2018. I'll talk the quarter first. The revenue for the quarter ended 31st March 2018 was 390 crore as compared to 315 crore last year, which is a growth of 25% on year-on-year. 34%. The crop protection business grew by 28% from rupees 137 crore to 176 crore. The pharma division grew by 21% from 178 crore to 215 crore. The EBITDA for the quarter ended 31st March is 71 crore as compared to 58 crore in the last year with a year-on-year growth of 23%. Very importantly, the cash PAT for the quarter ended March 31st is 47 crore as compared to 46 crore in the last year. I'll take you through now the year ended for the entire batch. The revenue for the year ended 31st March is 1,300 crore as compared to 1,034 crore the last year, a growth of 26%. The crop protection business grew by 29% from 423 crore to 547 crore. The pharma division grew by 23% from 600 crore to 753 crore. The EBITDA for the year ended 31st March 2018 is 242 crore as compared to 197 crore in the last year, with a growth of 23%. The cash PAT for the year ended 31st March 2018 is 163 crore as compared to 140 crore in the last year, with a growth of 16%. Coming to our balance sheet ratio, the gross debt of the company stands at 515 crore and the net worth of the company stands at 670 crore. Just to brief you about the working capital days has also reduced to 150 days from 160 days last year. The board has recommended a final dividend of 50 paisa per share, which actually aggregates 1.2 rupees per share, including interim dividend which we declared in the last quarter, 70 paisa. The board has also recommended issue of bonus shares in the ratio of 1 equity shares for every 2 equity shares held, which is subject to approval of the member of the company. We now open the floor for the questions. I think, yeah.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Participants are requested to restrict their questions to 2 per participant. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Sudarshan Padmanabh from Sundaram Mutual Fund. Please go ahead.
Hello, thank you for taking my question. So my question is around both parts of your business, the crop protection side to start with. The last 2 quarters has been pretty buoyant in terms of growth. Sir, I would like to understand, number one is what we are hearing is that the overall inventory channel, especially in Brazil and other markets, have come down. And the crop economics is also improving across major crops, soya, corn. And second one is if you can also throw light with respect to your own molecules. I'm sure that number of molecules that we are working with. So what has really led to this kind of a growth? Whether it is new client addition or molecules progressing from a smaller scale to a higher scale. Kind of give color with respect to what is the kind of size of this business, what you envisage in probably the next 2 to 3 years from where it is.
Yeah, hi, thank you. This is Samir Hiremat, CEO of Hikal. Coming to your first question about what is driving this growth in the crop protection business, I think the reasons for the growth is the business, as you correctly mentioned, is turned. The crop protection business globally goes through a cycle every 6 or 7 years. I think that the downturn has already taken place in 2016 and 17. And the inventory channels have been, material has been consumed from the inventory channels. So real demand is coming in from all our customers. And that has started to play in from our quarter 3 and quarter 4 onwards. And we expect that demand to continue going forward. A large part of our growth this year came from existing molecules which went up in volume due to increased demand, but also due to introduction of some new products that we did for some of our large innovator clients on the crop side, which we launched in the early part of 2017, which gained traction over the entire year. We are, being a quality supplier, we are getting a lot more business. And what we're seeing is because of the problems being faced by the Chinese chemical industry, a large part of the business is shifting towards India. And for reliable companies like Hikal, we are seeing a lot of growth opportunities and a lot of inquiries for enhanced business from a lot of the large, big crop protection companies going forward. Thank you.
Sir, with respect to how you believe the traction is going to take place over the next 2 to 3 years, in terms of size and in terms of the business salience, where do you think that this crop protection business would be there in the overall scheme of things?
Well, I think we're pretty comfortable with growing at about between 15 to 20% in our crop protection business going forward. And we already have several molecules that were in development, which we will be launching year on year. So we're pretty confident of growing between 15 to 20% going forward year on year.
And so just, another, thing on the crop protection business is, while you mentioned about the Chinese competition, it's, shutting down capacities and the, benefits coming to India. On the other side, for a lot of, base chemicals, the prices have shot up. So, I mean, even, in terms of margins, while the top line is healthier, I think the margins across the board, appears weak. How do we see, this, intermediates and the base chemicals manufactured from China? Would the, the cost pressure intensify, or do you think this is the kind of peak, or do we see any chances of certain capacities coming down by which the prices might actually soften from here?
Yeah, I think the Chinese situation, I think the worst is behind us. Prices have gone up considerably in the last year. We're seeing some softening in Chinese raw material prices as more and more capacities come back on stream. However, they're not going to go back to the pre-set 2017 levels. But in our custom manufacturing business, all the price increases in raw materials are passed on to our customers. So Hikal doesn't get impacted because of the increase in raw material prices from China or anywhere else. So we're able to pass on 100% of the increase to our customers. So we don't see that as an issue here.
I have more questions, but I'll join back later.
Thank you, sir. We have next question from the line of Parth Desai from Hikal Capital. Please go ahead.
Hi, yeah, thank you for the opportunity. So what percentage of our raw materials do we import from China?
About 35 to 40%, 35% approximately.
Okay, got it. And if I understand, for the 70% of the business, which is contract manufacturing, we pass on all of the increases to our customers, and for the rest of the portfolio, it's market-driven.
That's correct. That's correct.
Okay, perfect. Thank you. And then my next question was on the capital work in progress. So I see 115 crore, more or less, capital work in progress on the balance sheet. Does this relate to Panoli, Jigme, or Mahad?
That relates to our pharmaceutical business and also to some part of the crop protection business. It's spread across our various sites.
Okay, got it. So it's a mix. And then we got 2 environmental clearances this year for the, I believe, the Jigme and the Mahad expansion. So if you could just give a brief status on where we are and how much more capex would be required to get these 2 projects on stream.
Yeah. I think we are, we've got the environmental clearances for all our sites. So because the next big thing that's going to happen in the Indian chemical industry is environmental compliance. And the same thing is happening in China is going to happen in India as well. So luckily, Hikal has always been above board and maintained very high standards. So all our sites have future-proofed in terms of environmental compliances for the next 5 to 10 years. We have enough capacity from an environmental clearance perspective. Based on that, we're putting in place a capex plan, which we're putting in about 250 crores over the next 2 years, which we'll be putting in terms of capex.
Okay, thank you. Okay, that's all from my side. I'll rejoin the queue. Thanks a lot.
Thank you, Mr. Desai. We have next question from the line of Saravanan Viswanathan from Unifi Capital. Please go ahead.
Yeah, thanks for taking my question. So in terms of, you had, as a sort of guidance, you had indicated that you'll be able to grow 15 to 20% for the next few years with the current margins intact. But as you had clearly explained that about 70% of your business, your material cost is getting passed through. So given that scenario, how should we evaluate, EBITDA growth, absolute growth in EBITDA would be more realistic, right, to evaluate that instead of the margins?
Yeah, I think that's the correct assessment. Absolute EBITDA growth rather than percentage EBITDA.
So would it keep pace with the sales growth, or do you expect, because of the focus on value-added products and also 30% of the business where you have your own products, so given that, do you expect EBITDA to grow higher than the sales?
I think we're more or less in line with the sales growth. Little bit of plus minus, but we should be in line with the sales growth.
Okay. And in terms of
capital expenditure and R&D expenditure, what can we expect in FY19 and 20?
So capital expenditure, as I mentioned before, we're spending about 250 crores over the next 2 years. A portion of that, about 100 crores, will be used for infrastructure, about 150 crores will be used for growth capex. In terms of R&D expenditure, as a company, we spend between 3 to 4% of our revenue on R&D, and we expect to continue that spending going forward.
Okay. Just one more bookkeeping question. What will be the effective tax rate going forward? Because this year we observed that tax rates have gone up.
I think the effective tax rate is about 32-33%.
Okay, so that's going to continue.
Yes.
And just one question about the history. So in the last 10 years, if we observe that, I think around 2014-15, has there been any change in the segments, or because margins as well as sales, everything, especially EBITDA, everything has taken a sort of knock during that time. Any specific reason?
Well, we had some of the products. We had forced to file opportunities for some of our products in those years, which have, there's a lot of competition, and we also had a lot of people in the organization, and we put in place our new strategy. So the margins did come down a bit in the last 2 years, but I think now we expect the margins to be pretty steady and constant, maybe slightly on the increasing trend going forward.
Okay, that's useful. Thanks a lot. All the best.
Thank you, sir. Participants, to ask a question, please press star followed by 1 on your touchtone phone. We have a next question from the line of Devang Mehta from Bay Capital. Please go ahead.
Hi, Samir and Anish and Sandeep. I have a couple of questions. First, in terms of what are the new products that are coming up both in crop protection and also in our pharma division. As I assume last year also we had launched a couple of herbicides for Japanese companies and fungicides, and we are also developing biocides. And how do we look at particularly biocide, because we are hoping that that particular category would grow very fast?
Yeah, I think the crop protection side, we're developing a lot more new on-patent products for our customers. On the biocide segment, we are seeing a lot of growth potential in these molecules, primarily in the domestic market, because a lot of the products in the biocide segment have been imported from China, and there has been shortages coming out of China, and we're seeing opportunities, and our biocide business will grow based on that. Also, on the pharmaceutical side, the segments that we're looking at is the CNS and anti-diabetic portfolios, where we're launching new molecules.
Okay. So, can I broadly understand what kind of revenue contribution is coming from new products for last 2 years, both in crop protection as well as, because a lot of focus after a management change 2 years back, both in crop protection and pharmaceutical, have led to a lot of new launches. So just trying to understand what kind of growth is coming in from these categories.
See, on the custom manufacturing side, when you get a product, then it's a large part. But if you look at our DMF filings, every year, it takes a few years for the DMF filings to get commercialized. So typically it takes 3 to 4 years for them to commercialize the product. But any given year, we keep on adding 5% more to our new products on the percentage of our revenue.
Okay, so do we have any benchmark as a sort for currently what percentage coming from new products, and where do we aspire to go to? Is there any benchmark internally?
We are currently at around 15 to 20% currently. That's the current run rate that we have, and we expect it to go to about 25% per year going forward.
Revenue from new products?
Yes, we're currently about 15 to 20%, depending on the year. If you get a large contract manufacturing product, it's closer to 20, so it will be about 15%. But we are expecting to be going higher, closer to about 25%. So 20 to 25% is the range that we're looking for new products year on year.
Okay. And coming back to this bio side, is there any, I presume that our R&D facility in Pune is working on these biocides. So what kind of market opportunity is there, and what would we be able to capture over next couple of years?
It's about a $2.5 billion market globally. The Indian market is also pretty substantial. I don't have the exact numbers in front of me, but it's a very large opportunity for the biocide segment. And it is growing. It grows. Typically, the biocide market grows faster than the GDP of the country.
How easy or difficult is to enter this market and get
barriers to entry are high. So unless you have very good chemical and technology expertise, it's not easy to enter. That's the reason why there's no serious biocide player in the country. They're all coming out of China right now.
Fine. I have certain bookkeeping questions. What, if I can understand, we have restated our receivables, which were in FY17 annual report, I can see as 160 crores.
Right.
And this is, the current number is showing some 250 odd crores. So I just wanted to understand what would be a like-to-like number of 160 crores for FY18 in our receivables.
Yeah, basically you have to reduce 132 crore out of that. So you'll get the current year numbers.
Okay. And what would be our, so we are planning a 250 crore capex. What would be our targeted net debt over next 2 years? Or most of it will come through internal accruals?
Less than 1. Yeah. Their equity ratio will be less than 1.
Okay. So it is less than 1 as 0.7, 0.8 as of now. It will continue to remain at that.
Yeah, we're confident of maintaining that, yeah.
Okay. Because our cash profits are very high and I thought we would draw down on debt in coming years.
No, we believe in a 50-50 type of approach. 50% internal, 50% debt for our capex spending.
Okay. And one last
question. Sorry to interrupt. Would you like to come back in the queue?
Okay, no issues. Thanks.
Thank you, Mr. Mehta. Participants, kindly restrict your questions to 2 per participant. We have a next question from the line of Chirag Dagli from HDFC Asset Management Company. Please go ahead.
Yeah, so thank you for the opportunity. Sir, what is the nature of the unallocated expenses, this 24, 25 crores that keeps coming every year? What is the exact nature of this, and how should we think about this going forward?
Typically, if you look at from the segmental standard point of view, what segment basically state that if you cannot identify certain expenditure allocable to the segment, you can put it to unallocations. Also, typically, if you look at the, we have a CBD office, we have certain expenditure there. So we are allocating on reasonable basis, and then certain expenditure remains unallocated in the system.
Yes, sir. Can you...
Corporate expenditures.
No, I understand that, sir. Can you be a little more specific as to what is the nature of this? 27.5 odd crores is a fairly large number. Just, sort of any more color in terms of what exactly?
I can tell you about salaries part of the, corporate office. We do not allocate 100% salary to the segment.
Oh, okay.
Because we keep still developing, we always believe we'll be doing extra businesses, so we don't allocate to the segments. So this is one part of the salaries costs are there. There are certain other expenditure also there, which also not allocated to this. IT expenses are there, which are not allocated to the segments.
Okay, sir. And then the second question was, sir, is INR a pass-through for the custom synthesis, both crop protection as well as farm?
No, it's protected.
I think currency fluctuations are covered. They're protected against that.
So basically the way we should think about your business is earlier you mentioned absolute EBITDA terms, but I think the right way of looking at it is EBITDA in US dollar terms, or is that understanding right?
Not really. Typically, basically, if you look at all our contracts where we have the exchange rate fixed, so we can always say that, our EBITDA is fixed in terms of the absolute numbers. Because, see, you may look at the dollar fluctuation, increase in that, but that doesn't matter to us.
Okay, fair point, sir. And the last question, if I may, the annual report talks about you having developed a enzymatic process for pregabalin. Is this a significantly large opportunity, sir, as we get along in the next, say, 12 to 24 months?
Yeah, I think we got an innovation award last year for this chemical process, an enzymatic process. And it's a very unique process, and we've got our own process patterns, and we believe that we'll have a very strong cost position. Plus, we are fully backward integrated on this chemistry versus our competitors who buy the advanced intermediates from China. So,
is there any color on how big this opportunity can be?
I mean, typically we look at a product in excess of 50 crores, and then we said it's a good opportunity. So it will be in excess of 50 crores.
Okay, sir. Thank you so much.
Thank you, sir. We have a next question from the line of Sunil Kothari from Unique Investment. Please go ahead.
Sir, congratulations for a very good performance. Sir, my question is regarding, I think what you mentioned is crop protection, 20% is contract manufacturing?
No, it's 70%.
70%, okay. And 50% in pharma?
In pharma, 50%, that's right.
Right, okay. So, sir, remaining business seems to be on a spot market, I mean market-oriented prices. There is nothing like a fixed cost plus something. So how we mitigate those, volatility in the raw material prices, because we are dependent on Chinese import also. So some thoughts on those things.
So we have, even in our business on the pharma side, which is 50% generic, we work with a lot of the large generic companies, and in many of those, we have annual contracts where we have some linkage to raw material prices. And if there's a runaway increase that could happen last year, we could go back to our customers and increase prices. We have that flexibility. And also we are backward integrated in many of the raw materials that we do on the generic side, so that the reliance on imports has come down, and it will come down even more in the coming years.
Mm-hmm. Okay. So, dependency on China is reducing, that is what you mean to say now?
Year on year, aggressively and vigorously looking at reducing our dependency on China. Okay. Not our strategy.
Okay. And sir, any benefits or maybe any negative effect of this currency depreciation, or we are not benefited and we are not affected also?
So I think on a net-to-net basis, it's a positive for Hikal. We will benefit from the currency difference.
Okay. So there is a scope for improving margin?
You can say that, yeah.
Okay. And so last question is, this unallocated expenses, I'm just maybe repeating, it has gone up from 3 crore to roughly 12 crore. Quarter on quarter also it has increased. So any one-time or exceptional expenses there, or it's a...
Yes, there is some expenditure, basically the revaluation of the exchange, and we have done the ERP upgradation this year, which we have gone live from 1st February. So there are some large expenditures sitting in those unallocated expenditure.
Which is a non-recurring type?
Yeah, absolutely.
Okay. Would you like to quantify those numbers?
It's not fair on my part.
Okay. Thank you very much, sir. Good luck.
Thank you, sir. We have next question from the line of Anand Bhavnani from Samiksha Capital. Please go ahead.
Thank you for the opportunity. Sir, my first question is about our pharma business. Historically, it has not done as well as agrochem. So, if you can help us understand, going forth, how do you see return on capital employed in pharma vis-a-vis or agrochem?
I think in pharma business, the growth will come from new products, and the new products will be typically at a higher margin than the current business. So we expect the margin profile of the pharma business to improve year on year, and that will have a corresponding impact on improving our return on capital employed.
And, sir, capacity utilization-wise, what would be the capacity utilization in pharma and agrochem respectively?
Both our businesses are about 70% right now. So, we're pretty comfortable for the next 1.5 years in terms of current capacity.
Okay. And so the expansion you mentioned early in the call, how much of it is for backward integration vis-a-vis capacity expansion for kind of existing products?
I think it's a combination. I don't have the specifics here, but it's a combination of both. Yeah.
Okay. I shall come back in the queue for additional questions.
Thank you, sir. We have next question from the line of Atul Thakkar from Dharamshi Securities. Please go ahead.
My question has been answered. Thank you.
Thank you, sir. We have next question from the line of Apurv Mehta from KSA Shares and Securities. Please go ahead.
Sir, congrats on good set of numbers. Sir, just wanted to ask the growth which we are around 26 to 28% is due to it was a volume growth or because of the hike in raw material prices value growth more. So what will we quantify? What will be our volume growth and
It's a combination of the two. I think volume and value.
Okay.
Yeah.
So it would be more towards that the value of raw material has gone up and that's why the growth is there. It would be on the normalized basis it would be 20% growth. Okay, we can envisage that.
See, our growth is, as we've indicated, is going to be between 15 and 20% year on year over the next 3 years.
Yeah.
So it's not going to be 26 to 28% as you had made in your earlier comment.
Okay. And sir, on the tax rate, just wanted to get clarification because last year we had a tax rate of 23%, and
right.
This year it is 40%. So any one-off thing, or it was like for past any taxes were there, or what was there? Because today this quarter it was very high of 47%.
Yes. See, what will happen? This 35(2)(a)(b) section, which is the R&D benefit. Because earlier 200% has gone down to 150% now.
Okay.
And earlier we were getting some 15% on investment, that is investment allowance.
Okay.
Investment in plant and machinery, which is also not available this year.
Okay.
So these two are the big factors.
Okay. But still, sir, 40% is there. That is, I could not understand because it would be around 33% or something. It would be.
So if you look at our effective tax rate for the entire year is 32%.
Okay.
Against 23% last year.
But here we are paid around 44.73 crores. Deferred tax is different because it's.
You have to take deferred tax also into account.
Okay.
So our effective tax rate both together is 32% against 22% last year.
Okay. So we don't have any MAT credit now?
We have still got MAT credit. So in fact, if you look at from the cash flow point of view, we have not paid 43 crores.
Okay.
So we have paid 26 crore rupees. The balance has been utilized from the MAT credit. We still have the MAT credit available with us.
Okay. So why we have not, in the tax, we have not bifurcated that thing. We have shown as the tax payment, so we have not saved in MAT credit.
No, basically there is no MAT credit this year. We have utilized MAT credit. If you look at last year's results, it's shown 3 numbers.
Okay. So next year the effective rate would be around 32%. Okay. Thanks a lot. Yeah.
Thank you, sir. We have next question from the line of Ashish Thakkar from Motilal Oswal Asset Management Company. Please go ahead.
Yeah, thanks for the opportunity. So on your DMF filings, you said, you're going to file more DMFs. So these are largely the generic, the products which are going off patent. You feel there are a lot of opportunities wherein you can cash on. Is that the general thinking, or this is something which is coming directly from the clients?
It's a combination. Some of our existing clients are also asking us to look at some of their products for life cycle management with the big pharma companies. And then we're also looking at our own strategy of finding our own products, which will get launched in the next 3-4 years.
So would it be safe to assume the request is coming also from the Indian companies?
Yes, very much.
Okay, fair enough. And what are the number of filings that you are targeting, the DMF ones?
About 4 to 5 per year is what we feel comfortable with doing.
Okay, and what, as per your assessment, would be the typical approval timelines?
Well, we typically file a DMF at least 3 to 4 years before launch. And after we file it, it takes 2 to 3 years to get approvals by the time we start the sales.
Okay, fair enough. So if you can throw some more color on your clinical pipeline as to, I don't know if you are comfortable sharing this, about your phase 2 and phase 3 pipeline broadly, if you could help us with how many number of molecules are there in the phase 2, probably early phase 3 or late phase 3?
So I don't have the breakup here, but we have about 4 or 5 molecules between phase 2 and phase 3 and about 2 products going into phase 3 right now.
Phase 3. So nothing in the late phase 3 sort of kind of?
Not in the late phase 3, but hopefully they move ahead soon. Yeah.
Okay. Okay, fair enough. Thanks a lot, sir, and all the best. Thanks for the opportunity.
Thank you, sir. We have next question from the line of Rajesh Kothari from Al-Securate Advisors. Please go ahead.
Good afternoon, sir. My first question is, generally in CRAMS business, it is very volatile business because if you get one successful, click, then, then the tonnage and the volume grows up significantly. And here you are talking about 15-20% kind of a compounded growth. So is it assuming without any one-off big success, or how is it?
Yeah. I think one-off successes we cannot predict. We are predicting very predictable business. Very reasonable business, we believe, that reasonable expectations are 15 to 20.
Can you be a little bit louder? I'm not able to hear your voice clearly.
Okay, one-off, we cannot predict and we cannot build that into our projections. We confident our current business and what we have in the pipeline is 15 to 20.
Okay. Possible. And this 15 to 20% business growth, what you are saying is across both the segments, or is it driven by one of the segment which is going to grow higher than the other?
It could be a little bit up and down on a year-to-year basis, but if you look at a 3-year horizon, I think it will be 15 to 20% across both the businesses.
And within both the business, the revenue mix also is going to be generally same across, or you think the generics may do better than CRAMS?
The objective is to have a 50-50 type of approach and try and maintain that. Maybe 1 year it could be up and down 5-10%, but we'll try and maintain a 50-50% type of approach.
Okay. And in terms of, you said there is some one-off expenditure in FY18. How much you said is what is the quantification of this number?
It is 3.5 crore. That's it.
That's it. And this 3.5 crore is in the fourth quarter, or is it for the full year spread out?
It's fourth quarter.
Full yearly spread out across 4 quarters?
Yes. No, it's the fourth quarter.
Fourth quarter. Okay. And you said that, the agrochemical industry is showing some signs of revival. But if I hear, conference calls of many other global and local companies, they are still, kind of very muted recovery they are talking about. They're saying the industry is still not out of woods and, recovery is probably is only right now hope. It's not yet started. So can you give some color on that?
Well, I think, I don't know, our customers have, whatever we do in 2018 will be put into the channels in 2019. So 2018 will be a modest recovery, but they're pretty confident that 2019 will be a better year. So whatever we produce and sell this year will go into the, the channels for 2019. We are seeing growth opportunities from all our customers.
I see. Great, sir. Thank you, sir. Thank you very much.
Thank you, sir. We have a next question from the line of Varun Daga from Girik Capital. Please go ahead.
Hi. Most of my questions are answered. I just have one question. If you could give us, the breakup in terms of seasonality, I just want to understand, is there any seasonality between quarters? Is first half better than the second half? Could you give us some light on that?
Well, typically our business, the first half is lower than the second half. That's the nature of our business, because in the first half of the year, we'd have our annual maintenance shutdown, and a lot of the sales, they start taking place more on the second half of the year. And that's been the nature of our business.
And any, in terms of percentage, if you could, give a rough breakup, it'll be helpful.
But I think historically the numbers are about 40-60, 40% first half, 60% second half.
Okay. So that's it from my side. Thank you so much.
Thank you, sir. We have next question from the line of Amar Mourya from MK Global. Please go ahead.
Yeah, hi, sir. Congratulations for a very good set of numbers. Sir, I have a question primarily related to, if I see your business model today, it is primarily more of a linear business model where you invest your fixed asset and then the top line grows. So that is the reason your sweat asset ratio is always either 1 or 0.9 times. So, but typically if I look a normal CRAMS business where a sweat asset ratio can go up than 1 times. Is it possible now, given that you are at a phase where you are seeing a penetration in your existing client base, can we see your sweat asset ratio going up from here, from 1 to say 1.5, 1.7 times?
Yeah, I think for the new products, our asset turnover ratio will be higher, closer to the 1.5 to 1.75 ratio.
Mm-hmm.
And the new products will come in from FY19, FY20 onwards.
Okay.
They also be brownfield expansion, so the asset turnover ratio will improve.
Okay. But then why it is happening? It is all happening because of the nature of the product, or you are going to leverage few of your existing facilities and something like that?
Yes, we are not going to build any new sites. Our sites have existing space to expand.
Mm-hmm.
All the infrastructure, most of the infrastructure is being built. Like, the wastewater treatment plant, the warehousing, the land already exists. So all that is already done. So we just have to put the plant building and some utility expansion maybe. So it's a brownfield project. So the asset turnover ratio will be far better for the newer projects.
Got that, sir. Got that. And like say, if I see your existing site all across, how much is the unutilized portion? Is there a scope to expand, say, let's say 40-45% in each of your sites?
Yeah, in 2 out of our 4 sites, we have about 50% expansion space capabilities. In the other sites, we have about 50 to 20% in 2 of our sites. But the 2 big sites, our biggest sites, in Panoli and Bangalore, we can expand about 50 to 60%. So there's a lot of expansion space. Okay.
And if, sir, one last, let's say if you see all your plant site, if they are fully utilized, at what sweat asset ratio we can see from the current level?
About 1.25 to 1.3 should be the combined sweat asset ratio by then.
All across? All across,
yeah.
Okay. Thank you, sir. Thank you. That's all.
Thank you, sir. We have a next question from the line of Chirag Dagli from HDFC AMC. Please go ahead.
Yeah, sir. Thank you for the follow-on. Sir, this R&D spend, can you split between the 2 businesses, crop protection and pharmaceuticals?
It's a centralized R&D, so it's very difficult to split the spend, but it's more or less in line with the revenue of and the opportunity. Depending on the opportunity, it's pretty flexible, but kind of in line with the revenues of the business.
So the 3% to 4% is, it's even across both the segments.
Yeah.
Right. And this CapEx, 250 crores that you're going to do over the next 2 years, is this largely going to be on pharma or crop protection?
It will be on both. We are seeing opportunities in both the businesses.
For both the pieces?
Yes.
Right. And, sir, in terms of working capital, as we go along, in the past, your working capital has been fairly efficient. Do you see any change in this, working capital efficiency for the business as a whole as the mix changes or anything else that is happening within the business?
Yes, certainly there will be some impact because of the increase in the turnover. But, this GST has really impacted us probably to all the industries. So, we'll have to see that how the GST roll out quickly, and then let's see.
Right. And just one last question, sir, on the custom synthesis piece for the crop protection business. In your opening remarks, you mentioned you have about 10 to 11 products in custom synthesis for crop protection. What was this number, say, 3 or 4 years back, sir?
It was less than half.
Okay, sir. Thank you so much.
Yeah. Thank you, sir. Ladies and gentlemen, due to time constraint, we will take the last 2 questions. We have a next question from the line of Sanjay Lada from Profit Value Fund. Please go ahead.
Yeah, thank you for the opportunity, sir. My first question will be, who are the major competitors for us and what is our competitive advantage and what rate industry is growing, sir?
Sorry, could you repeat that? I couldn't hear you. Can you repeat that, please?
Hello?
Hello?
Yeah. Can you hear my voice?
Yeah, now it's clear. Yeah. Please go ahead.
Thank you. So who are the major competitor for us, and what is our competitive advantage vis-a-vis our competitors, and at what rate industry is growing?
I think for the crop side, I mean, definitely, if you look at India, there's PI Industries, which is a competitor. Globally, there is Saltigo and Lonza. On the pharma side, there is Divi's is a competitor, and Dishman, Carbogen Ansys is a competitor. And globally, Siegfried and Lonza is a competitor. But we are a hybrid model, so we have fewer competitors on the hybrid side, but the segment-wise, we have 3 or 4 major competitors in each segment.
So can I know what is our competitive advantage, how we are different from that, and what our strategy is different from them?
I think technology, chemistry, sustainability, environmental compliance, quality standards, track record, backward integration, and we're the only company in the country today that has a hybrid business model of our scale. So we have we can backward integrate, and that is the expertise that we have. We have the US FDA clean track record. That all adds to our competitive advantage.
And at what rate the industry will be growing? Can you?
Well, the industry on the pharma space goes at about 3 to 4%. Crop grows by about 2 to 3% globally. But for our space, I mean, I don't have the numbers here, but I think 10 to 15% is
maybe less.
8 to 10%. 10% is the type of growth our outsourcing business could grow at globally, and we could grab a larger percentage of that pie.
The last question
sorry
will
to
be...
interrupt. Would you like to come back in the queue? I'm sorry to interrupt, sir. Thank you. Ladies and gentlemen, we will take the last question. The last question is from the line of Miloni Bagadia from IDFC Securities. Please go ahead.
Hi, thanks for the Nitin from IDFC. Just quickly, sir, on, when you look at the growth opportunities for the 2 segments, qualitatively, are there any, is it difference in the kind of nature of the business that you're looking at? For example, is there more of the CRAMS piece which is there in agrochem, and in pharma, versus the innovative CRAMS piece, what are the kind of opportunities you see on the pharma side for growth over the next 2 to 3 years?
I think, historically, our business has been more on the CRAMS side if you look back historically. On the pharma side, the short-term opportunity, I would say, over the next 2 to 3 years would be more on the generic side, and some custom synthesis opportunities, but the larger opportunities will be more on the generic side right now.
And so that would comprise of the comment you made earlier in terms of you filing your DMFs and sort of scaling those DMFs for innovators as well as for the generics.
That's correct.
And so, and obviously for the opportunity that you see for the next 2 to 3 years would be on products that you've already got approvals for or close to getting approvals for, right?
No, in the 2 to 3 years we've already got approvals. The ones we will get approvals will be beyond that.
Okay. And are there any specific products that you're excited about over the next 2 to 3 years which can be meaningful from a growth perspective for which you already got approvals for?
Yeah, I think pregabalin is one product that we believe from FY19-20 could be one good product for us. I'm pretty excited about that.
And is there any particular reason why, the custom synthesis has not been such, which has been like probably a larger component of your agrochemical business, that's been essentially a large, has been as strong a big constituent of your pharma business also?
Well, unfortunately, in the last couple of years, because of the FDA landscaping in India, many of the companies have been painted with the same brush. So there has been a shift to move away from India and outsourcing of custom synthesis. But it's coming back. I think you will start seeing that, companies now only have got to act together, and, Western innovative companies are now starting to look again at India.
If I just squeeze the last one in on that, and in the custom synthesis, in whatever discussion that you're having on the pharma side, are your discussions more around close to patent expiry products or even early stage products, sir?
No, I think they're a combination of both, under clinical development as well, and a few off patent life cycle management.
Okay, thank you and best luck.
Thank you.
Great. Thank you, everybody. I'll take this opportunity to thank everybody for joining the call. I hope we have been able to address all of your queries. For any further information, kindly get in touch with SGA, Strategic Growth Advisors, our Investor Relation Advisors. And thank you once again and have a great day.